You're listening to Confessions of a Bookkeeper, where we look at businesses through the eyes of their books. My name is Mark, your Chief Bookkeeping Officer, and I spent years cleaning up and reviewing some, let's say, interesting books. In this episode, we're talking about something almost every business owner faces at some point: falling behind on their books. Not because they don't care and not because they're disorganized, but because running a demanding business takes priority over, let's say, documenting it. And eventually tax season rolls around and those numbers just have to get caught up, and fast. But here's the thing: once those books are finally brought up to date, they can reveal an entirely different financial picture than what you thought was happening all year long. That's what this episode is about: understanding what it really means to catch up and what to expect once you do, and how to keep your footing once those numbers start reflecting your reality. When your books are behind, your bank balance becomes your scoreboard. It's the only number you can see. If it's high, things must be good. If it's low, you start tightening your belt. It's an understandable way to operate, but also one of the most misleading. That balance includes everything: payroll that hasn't cleared yet, tax payments that haven't gone out, and deposits that don't belong to you, and maybe even credit card payments that mask personal spending. All of that blurs the lines between profit and cash flow. So when we finally bring everything current, what happens next almost always surprises people. Because once transactions are classified properly and the reports start reflecting the business as it actually operates, not just what's in your bank account, the entire financial picture shifts. It's not that you've been doing something wrong, it's now that you're finally seeing the full truth. I've seen all kinds of personal items flow through a business: a mortgage payment for a home, or the full amount of an apartment lease that the owner thought they could deduct because they sometimes work from there. Even payments for a personal car that were never tied to the business. It's not unusual, it's just what happens when bookkeeping isn't done monthly. The problem isn't that these things occur, it's how they distort your numbers. When personal spending gets recorded as business income, your profit looks artificially low, and your tax bill seems smaller than it should be. So once those personal transactions are correctly classified as owner's draws or distributions, your taxable income rises. That's when the surprise sets in. Wait, how do I owe more taxes now? The answer is simple: those weren't legitimate business deductions to begin with. Expenditures don't always equal expenses. For most business owners, this is the first time they've seen their company finances stripped of all that noise, and it's normal to feel a little stunned by that. You worked hard, you spent your money, and you thought those costs counted for something. And they did, just not for the business's tax purposes. Bookkeeping doesn't change what you earned, it clarifies what's truly yours. That's why catching up isn't just an accounting task, it's a whole mindset shift. You're moving from cash equals success to profit equals clarity. The longer you wait to catch up, the more expensive and complicated the process becomes. Every extra month adds more statements to pull, more transactions to review, and fewer details to remember. There's a big difference between bookkeeping and reconstruction. Bookkeeping is active, precise, ongoing, and intentional. Reconstruction is detective work, piecing together context and trying to guess what happened months ago or years ago. And when you're juggling multiple cards, accounts, and vendors, guesswork can get expensive and fast. Catching up early isn't just cheaper, it's cleaner. It keeps your records accurate while the details are still fresh in your mind. Most business owners catching up their books are doing it because it's time to file taxes. And here's the part that catches almost everyone off guard. Once everything's cleaned up, the net income usually looks a lot higher than expected. That's not bad news, it means the business is actually profitable perhaps, but it also means there's going to be a tax bill. The best thing you can do at that point is try to get ahead of it. Talk with your CPA or your bookkeeping officer early. Run projections, estimate your tax liability, and start making payments now. Even partial estimated payments will save you penalties later. Once those first clean financials are in your hands, you're not just caught up, now you're back in control. After cleanup comes consistency. That's where the real value starts showing up. Because once reconciliations are complete and caught up, the financial picture is current, and you can actually start using your numbers to make decisions. That's where we step in, turning reactive cleanup into steady rhythm. Because the real win isn't catching up once a year, it's staying current every month. When your books are kept on schedule, questions stop piling up. You don't have to wonder what's deductible, what's personal, or what's missing. You'll already know. That's the difference between playing catch up and operating with control. If your books are behind, don't think of cleanup as a punishment. Think of it as a reset. You're rebuilding visibility into your finances so you can plan ahead instead of looking back. At Chief Bookkeeping Officer, that's what we help clients do every day: restore clarity, strengthen compliance, and keep their financial picture accurate from month to month. Because clean books aren't about just filing taxes, they're about your confidence in your numbers, in your decisions, and in your direction.